Joining us now, Allianz Chief Economic Advisor Mohamed El-Erian is here. In this case, tech selling off, but it's not because suddenly the 10-year got out of control, Mohamed. That's still been well behaved, still between, still around 1.66%. But would you acknowledge perhaps the recent moves we've seen in commodities and maybe in inflation, CPI, PPI? Has that got people thinking that the Fed may have to do something in terms of tapering sooner than we thought before? Is that what this is all about, the gravy train ending sooner than people thought? Or what is it?
So if they thought that the Fed was going to change its policy course, and good morning, Joe, you would see the 10-year move. No, this is something else, Joe. This is the markets worried that the Fed will be late.
Really?
And that's why you get this the market itself starting to question the liquidity paradigm. Because if the Fed turns out to be late, then the Fed may have to slam on the brakes. So what you're seeing is nervousness, not that the Fed will move, otherwise the 10-year will be much higher in yield, but nervousness that the Fed will be stubbornly holding on to its transitory mantra about inflation, while other central banks are changing course, while people are increasingly saying, hey, look at the evidence on the ground.
Why wouldn't that, if doesn't late imply that they lose control of inflation, and therefore you would think that people would be selling bonds and yields would be going up if the idea is that they're behind the curve on inflation?
You would, Joe, except you've got a central bank with a massive printing press in the basement, buying 120 billion of assets every month. So do you really want to challenge the Fed at this point when it's buying all this? No, you don't. So what you're seeing is other assets that the Fed does not impact directly. In the past, when it wasn't buying assets, when we didn't have QE, you would have seen the curve at this point move much more, because the Fed would only be able to control the short end of the curve with its interest rate policy. But because it's buying so many assets, it actually has much bigger influence on the whole curve than in normal times.
We see a lot of you, Mohamed. We see a lot of Jim Paulson, too. And I know you watch pretty closely, Mohamed. Remember Paulson said, when we are smack dab in the middle of reopening and it becomes clear, that's when we get perhaps a 10 to 15 to whatever the sell-off would be from some of these lofty levels, and then maybe we head higher into the rest of the year. Is this the beginning of something like that, do you think?
So I don't know whether it's a beginning, because you have to shake the market's confidence about the liquidity paradigm in order to get the 10 to 15%. Maybe we are. But it's very curious. I never thought we would have a call, Joe, where we say that the Fed may even lag the European Central Bank. The ECB is starting to signal that it may consider tapering, whereas we, with the Fed, are not even thinking about thinking. I mean, think of that contrast. And it's not because European growth is better than us. It's not. It's not because they have a looser fiscal policy than we do. We have a looser fiscal policy. It's not that the inflation is higher than ours. It's not. And it's not because there's more risk-taking going on. It's just that the Fed, with its new monetary framework, has gotten itself pinned in a corner, and they're not quite sure how to exit.
Shepard Smith here. Thanks for watching CNBC on YouTube.